Hey everyone, welcome to Friday the 13th, November 2020, and it's time for the International Tax Lunch. Phil Hodgen here from glorious Pasadena, California, and we do this on the second Friday of every month at noon Pacific time. You can listen online just like you're doing right now through CalCPA, or we post these things later on YouTube. This month, I will be talking about choosing a holding structure for investment in U.S. real estate when you're a non-resident investor. And this month's topic is going to be specifically aimed at talking about why using corporate structures and irrevocable trust structures are so fabulous. Next month, on December 11th, I'm going to be talking about using partnership structures for U.S. real estate investment. And forewarning, I'm not a big fan of partnerships, but they exist and you have to know how to handle them. But mostly I walk down the street yelling, unclean, 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 when I see partnerships and I try to reconfigure them into something else. So, anyway, so that's what's going to happen today. We can save all your questions and email me. Email the slides on the back end. You have my email address. It's phil@hodgen.com if you need it. Happy to yap, happy to brainstorm. We can see what we can do with it. Anyway, let's go do this. Part one, the introduction. That's an allusion to Monty Python. Part one, the larch. All right. Here is the nut that we're going for. Everything when you've got a non-resident alien investor, or in fact, any kind of real estate investor, what goes on the grant deed as the grantee, as the owner of that real estate, that drives all of the tax results. So income tax, estate tax, everything. So what we are talking about today is how can we advise a client to choose the right answer to what goes on the grant deed? How am I going to own it? In my own name, in a company, what kind of company, blah, 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 blah. So always focus on this because sooner or later, as part of the purchase price procedure, the escrow company will call and say, what do you want here? And you have to make a decision. So here is a sort of simplified version of all of the possible answers if we have a single real estate investor, a non-resident alien, sort of contemplating what to put on that grant deed. It's simplified because there are a lot more variations on this than I've put here. For instance, you see the little one that says domestic corporation owning some real estate. Well, yeah, you could slot an LLC underneath there as a disregarded entity. And there are more variations than that, but these are the main families of structure choices that you have when you're thinking about how should a non-resident alien buy U.S. real estate. Note today that I'm going to ignore multiple ownership, when you have 2 people, 3 people, 4 people. And I'll deal a lot with that by next month on December 11, because of course, partnerships by definition have at least 2 people involved in the equation. So from the left in green, direct ownership. So investor's name as a human is on title. The next 2 categories, that sort of blood red, maroonish, whatever color it is, we're using disregarded entities. You could have a domestic disregarded entity, an LLC, or you could have a foreign disregarded entity, for instance, a BVI corporation, and you make a check the box election, and that could be the owner. In the bluish, interesting blue color category, we have corporate structures. So domestic corporation owned by a non-resident alien individual, a foreign corporation where all the stock is owned by the non-resident alien individual, or some sort of double-tiered structure. Could be that some other entity is a disregarded entity. It could be a C Corp, something like that. And then finally, to the right in beautiful purple, we have trusts, revocable trusts and irrevocable trusts. So those are the families of choices that you're going to be working with. And let's just sort of go through what works and what doesn't work. What we're going to do is we're going to optimize for tax. We don't really care about the management stuff right now, though management is really, really important, especially extremely boring stuff like how do I open a bank account or how do I pay the property tax without just going crazy with paperwork. These are important factors when you're thinking about a holding structure, but I'm only going to talk about tax. And in sequence from biggest to smallest, I'm going to talk about estate tax constraints, because if this investor falls over dead, the last thing you want to have happen is a 40% estate tax being imposed, because that investor's heirs will be grumpy. The next one we're going to talk about is capital gain tax. And then finally, we're going to talk about what do we do in these structures for income from rental of the property. And as always, all of this stuff that we're going to talk about costs money. It costs money for clever lawyer tricks, the kind of stuff that I would do, tax returns, accounting, and all of that stuff. Some things are more complicated than others. For example, trusts are a pain in the neck to set up, and they're typically more expensive to operate than corporations. So it'll always be a cost benefit thing. So you want to concentrate not necessarily on the outlay, but what am I buying for all of the clever lawyer tricks and accounting fees and stuff like that. Let's talk now about estate tax, the big one. Everybody concentrates on this, and so it's not like it's going to sneak up on anybody unawares, yet it does. We seem to have about one 706 NA a year where people came in, got enchanted, bought a house in their own name, and then had extreme poor judgment and happened to die while still owning the house. So it happens. Here are the structures with a little star there that prevent estate tax. So when I'm making a little joke about clever lawyer tricks, these are the structures that are going to work for you and prevent the estate tax from incurring. And I'm going to talk about why, so you see the principles behind it. But if someone is serious and they have the notion ahead of time to set things up right, these are the choices they're going to have. They're going to set up a foreign corporation that owns the real estate outright. They're going to set up some sort of two-tiered parent substructure where the subsidiary owns the real estate and they own the shares of the parent company. Or they're going to use an irrevocable trust. And I'll explain why these work to prevent estate tax. So let's think first about what estate tax is. It's a combination of two things. You need a dead person, and then the second thing is that dead person has to have a gross estate. So we can't control when death happens. Some people think they can. And quite frankly, the probabilities are that at any given point, you're not going to die. The actuarial probability is quite low. But we can't control it. So it's kind of like buying a giant negative lottery ticket. And we want to minimize the negative payout from that negative lottery ticket that we call death. So here's my simple example, and we'll sort of walk through how it works. Just pretend that we have a non-resident alien investor who has 10 million net worth, parks 4 million into U.S. real estate, owned free and clear, no mortgage. What happens when this person dies? Here is an excerpt on slide 10 of the 706 NA. And so you see on line 1 and line 2, gross estate in the United States, and line 2, gross estate outside the United States. If you're working with a generic form 706 for a U.S. resident or citizen who dead and you're preparing an estate tax return, you're not going to have that distinction, line 1 and 2. It's just what's your gross estate. So line 1, we have to show all of the assets in the United States, and nothing screams I'm in the United States so much as dirt. So U.S. real estate on line 1, $4 million. Now on line 2, remember this person has $6 million worth of assets outside the United States, but I've put NA there. And why have I done that? Because the estate tax rules say that a non-resident is only taxed on stuff in the United States, and if you report just that on your 706 NA, guess what? See those empty lines 4 through 7? You get nothing. And line 8, total deductions, nothing. And so you have a choice when you're preparing the 706 NA to report worldwide assets and take a pro rata share of expenses and all that fun stuff. So you have a positive number on line 8 as a deduction, or you can give up on the deductions and just report your US assets only. And so I'm showing the typical scenario where you have only the US assets reported on the 706 NA, and you're saying, I don't care about the deductions. And in my example that I've given, you'd have a pro rata share of administrative expenses, for instance. So let's say that you had $100,000 of administrative expenses. Well, you get 40% of that as a tax deduction. What's the tax savings from 40%? $40,000 at 40% is $16,000 tax saving. It's hardly worth going through the exercise of mustering an inventory of worldwide assets and getting valuations and all of that just to save $16,000 of tax. So this is why typically you're going to see a 706 NA where we just don't care about the deductions. So what you're seeing here is, go figure, $4 million of U.S. real estate, and you've got $4 million of a taxable estate on line 9. And now on slide 11, we go and we calculate the estate tax. Start at the top with the taxable estate of $4 million, and you look at the bottom, 1.6 million and change of estate tax. How does that happen? Well, you do the normal math that you would do on an estate tax return, but look at line 7. This is the unified credit. Look how teeny tiny that is. And that's the clue of why you do not want a non-resident alien to have a taxable estate in the United States. They don't get the 11.7 million or whatever it is right now unified credit. They get a $13,000 unified credit, which offsets 60,060 of U.S. situs assets. So as a result, the estate tax is going to be very, very high for a person like this. So that's the result. Somebody comes and buys a very nice $4 million house as a vacation home, falls over dead, leaves the house to the non-resident alien heirs, and those heirs have a $1.6 million tax bill to pay just for the privilege of inheriting that house. So there's the problem in a nutshell. Now I'm going to walk you through why an irrevocable trust works to solve the problem, and then why a corporate structure solves the problem. So here's my little picture. There's words on the next page, so you don't have to take any notes or anything. You can see the reasons for everything. But here's the little picture. Assume the same $4 million house that's going to be bought in the United States. The settlor says, I'm going to create a trust for the benefit of my beneficiaries, spouse and children, grandchildren, blah, normal kind of trust. If the settlor now falls over dead, having put $4 million into the trust, and the trust buys the real estate, we say, what does that settlor own now that the settlor has graduated to decedent status? The answer is what's in the settlor, the decedent's name, as directly owned. And then what do we say? Do we sort of by inference say that the decedent owns the assets inside the trust? Well, sections 2036 through 2038 are the retained interest sections. And so if the trust has been poorly designed so that the settlor has control in one of the bad listed ways there, then the estate includes the assets of the trust. So the key to this game is do it right and do not allow the settlor to have any retained interests. And if so, the settlor can fall over dead, knowing happily that there's no estate tax at the time of his death. Similarly, let's look at the beneficiary. If we have a beneficiary and that beneficiary dies, what's included in the beneficiary's gross estate? Specifically, do we look at the trust assets? The answer is only if the beneficiary has what's called a general power of appointment. Basically, does the trust document have a clause that says the beneficiary can push a button and force the trust to distribute assets to himself, herself? And if the beneficiary has that power, then that's a general power of appointment. And when the beneficiary dies, the trust assets are taxed to that person. So the key to the game here is if you draft the irrevocable trust correctly, no retained interest for the person who set up and funded the trust, no general power of appointment for the beneficiaries, there is no estate tax on this U.S. real estate asset. There are the words and the advice: don't give the settlor a retained interest and don't give the beneficiaries a general power of appointment, and you win. And note that these are principles that apply to domestic trusts, they apply to foreign trusts, so it's all the same. This is just basic foundational trust law. Let's look at what the 706 hypothetically would look like. In fact, you wouldn't file one. See, now that we have no retained interest when the settlor dies, line 1 is 0. And if you trickle down and play the pachinko game of life with the 706 NA, taxable estate is 0, and we know that the tax is going to be 0. Now let's look at the same reason. Why does a foreign corporation prevent estate tax? And here's how it works. We say, all right, in the case of the irrevocable trust, the settlor, the person who funded the trust, owns nothing. So there's no asset at all owned. In this case, the decedent, the non-resident alien who fell over dead, owns stock in a foreign corporation. Stock in a foreign corporation is considered to be located wherever it was incorporated. And so it's a foreign situs asset. So you have a foreign decedent owning a foreign asset. And Internal Revenue Code section 2103 says, don't include that asset in the gross estate. And since we exclude it because of section 2103, the gross estate is 0, and therefore the estate tax is 0. Now, what happens below the foreign corporation level? You can add all sorts of fun in there, and we usually do, if only to be able to go open a bank account at Wells Fargo or Chase, so property taxes can be paid, management fees and stuff like that. And that has no impact on the estate tax results, because the only thing that matters is what did the decedent own? Answer: shares of a foreign corporation. Again, looking at the beautiful excerpt from 706 NA, we have a 0 gross estate in the United States because it's only foreign stock. Line 2, we chose not to add worldwide assets into the estate tax calculation, and therefore line 2 is 0. And then trickle down theory, line 9, taxable estate is 0, and therefore the tax is 0. So that's, in a nutshell, why you want to look at one of two structures to prevent the estate tax: either a foreign corporate structure or an irrevocable trust structure. Your only other choice, if you do not use either of those, is to buy a lot of life insurance and use that money to pay the estate tax. Now let's look briefly at things that don't work. Kids, don't try these at home. So this is sort of a replication of what I've done before. Direct ownership, we're going back to this idea of what do the decedent own when the decedent dies. So direct ownership is obvious. They own U.S. real estate. The domestic disregarded entity and the foreign disregarded entity ideas are interesting, but I think they're dangerous. There was a case, about 10 years ago, Suzanne Pierre versus Commissioner, where it's a disregarded entity case, a gift tax case, but the same principles will apply to estate tax, where a woman in New York put $10 million into a single member LLC, then gave away some membership interest to her kids and claimed a valuation discount. And the nut of this opinion says, the tax court says, disregarded means disregarded for income tax, but it doesn't mean disregarded for gift tax. And so you say, this is a problem. So it's entirely conceivable that one outcome will be that if the non-resident alien owns a single member LLC, domestic LLC, that LLC is a domestic asset, therefore taxable estate. Or Suzanne Pierre versus Commissioner might get reversed or overruled or something like that, or Congress might look at it and say, oh, this is bad. And they might say, no, disregarded means disregarded for all purposes. And in fact, that's what the code says. And in fact, in Suzanne Pierre versus Commissioner, that's what the IRS was claiming. And the tax code, the court said no. I think it's the more logical thing if the Internal Revenue Code says disregarded for all purposes, that's what they meant. But it's not where we are right now. So those two red zones, I think it's difficult to advise a client to do that unless the client wants to be a crash test dummy in a tax court case with a significant downside. And so as a result, I do not use pure disregarded entity structures. Domestic corporation. Remember how we said a foreign corporation is located wherever it was incorporated? Well, a California corporation formed in California is a U.S. situs asset. And so decedent falls over dead owning shares of a California corporation, there's a taxable estate. Revocable trust is an example of the retained interest. The person who sets up the trust and retains the power to revoke or amend the trust has a retained interest. And in that case, the Internal Revenue Code, I forget which specific section under 2036, 2037, 2038 it is, but it explicitly says you got a revocable trust, you've got a retained interest, include the value in the gross estate. So all of these are not good. And the moral of the story is if you come across one of these with a non-resident alien client who's still alive, see if you can do some restructuring to eliminate this, because otherwise you have an estate tax risk. So let's wrap up the estate tax discussion before we move on to the other stuff with just a quick summary. Yeah, the only two structures that work are the irrevocable trust idea or the foreign corporation at the top level where the non-resident alien individual owns the corporate stock. And then there's something below it, and subsidiaries or not, but ultimately that's what the real estate is in. So there we go. Those are your two answers. Let's move now to capital gain tax. This is the second big one. And under the current status of affairs for federal income tax, it's my opinion that the federal income tax rates don't matter, and you really shouldn't use these in making your calculations for what type of structure to use. Instead, you should worry about state tax instead. And here's why. So you look at the little sort of weird yellow color. I mean, the colors come out weird. What that you see on the computer when you set it up and what it comes in slides ain't the same. Corporate tax rate, 21%. Trust beneficiary, if you've got a trust and a K1 and the capital gain is passed through on the K1 to the trust beneficiary, tax rate, 20% for long-term capital gain. Incidentally, non-resident aliens do not pay Obamacare 3.8%. So that's why this is roughly par. I mean, 1%, you're really not going to roll over and spend a lot of money for restructuring just for 1% tax rate differential unless this is a massive, massive, massive property. On the other hand, look at California tax rates for corporate tax versus humans. Go a significant difference. 8.84% for corporations, and at the upper tier of income, so if you've got a big property and extremely high capital gain, as high as 13.3%. And there's not only a rate problem, but there's a tax deduction problem, whereas a corporation can take a tax deduction for state income taxes paid, humans cannot. They're limited to a $10,000 limit. And so that makes a big difference in the economic value of the tax deduction. So let's look first at the difference, a hypothetical $2 million capital gain. Tax rate differential on calculating your California income tax, selling a piece of real estate as a non-resident alien. Pretty big difference, say round numbers 180 for a corporation versus 240 for a individual thing via an irrevocable trust. So it's a significant tax differential. And then let's look at the impact of the state tax deduction on the federal income tax side of the equation. And you can see the difference, the second line of this, the second row of this table, the difference in the tax deduction, 176,800 for the corporation and only 10,000 for the trust beneficiary. And then the federal tax rate is 21 versus 20. This is just the way that you calculate the capital gains tax. You can't put that's why I say worksheet. And there's a little bit of AMT there for fun, because why not? But look, I mean, the federal income tax rate is not that much different, 383,000 versus 372,000. But the combined effect of those two, federal and California income tax, is pretty profound. So the 560,000 for a corporation versus 612,000 for a trust structure. So at the upper level, higher value assets where the capital gain is expected to be higher, you would favor a trust because you think that this is going to be beneficial over the long run because of state income tax. Now, of course, we have a joker in the deck that periodically Congress plays with the tax rates, and we don't know what they're going to do. Personally, I think corporate tax rates are at a historic low, and they will almost certainly go up. So I think this idea of federal tax being at par with the individual, I think that'll change, and it'll change in favor of individual and against corporation. So that's not the end of the story. Just because we've looked at the capital gains tax problem, there are a lot of knock-on effects, or if you read Nassim Nicholas Taleb's books, second order thinking, something that Congress doesn't do. If you have a corporation, a foreign corporation is the direct owner of the U.S. real estate, they're going to pay a capital gain tax, ordinary tax rate of 21% on whatever the taxable income is. And then you see here the excerpt from the Form 1120-F, they'll pay a branch profits tax as well on top of it. So you start with taxable income on line 1, and then you see dividend equivalent with a typo on line 5 at the bottom. So the branch profits tax is designed to roughly calculate how much cash does this foreign corporation have available for a hypothetical dividend to the shareholder. That's derived from your operations inside the United States. So please give us 30% of that. And so you start with line 1, you do a bunch of adjustments up and down, and you end with the dividend equivalent, you multiply it by 30%, and that's your branch profits tax. And this gets expensive because if you're paying 21% corporate tax and then you're paying 30% of whatever's left over, that's grumpy time. So you don't want to pay branch profits tax, you want to avoid it. And there are 3 prevention techniques for the branch profits tax. One is this amount of money that you have left over in the corporation after you have paid your corporate income tax. So let's just be hand wavy and call it earnings and profits. If you reinvest this in U.S. assets, then obviously you have less money available for a hypothetical dividend, and therefore the dividend equivalent base that you multiply by 30% is lower, and therefore the branch profits tax is lower. The second thing you do is in the year that the foreign corporation stops doing business entirely in the United States, you can jump through some hoops and you can exempt yourself from the branch profits tax entirely. And as long as you don't have that foreign corporation come back and start doing business again in the USA for the next 3 years, you're all clean. The third one is you can use a foreign parent and domestic subsidiary structure, and that works because who makes the capital gain if a domestic subsidiary owns the real estate? Answer: a domestic corporation. Branch profits tax only applies to foreign corporations, so winner, winner, chicken dinner. Let's look at these in sequence. First, the reinvest. So if you see line 4C, that's one of the adjustments. This is a subtraction that you take from taxable income in order to get to the dividend equivalent. So if, make it up, you have $1,000 of taxable income and you reinvest $1,000 into U.S. assets, then you have a dividend equivalent of zero, and therefore you have a tax of zero. And in fact, this is the process that I will use most frequently for people. I just tell them, look, if you've got a U.S. real estate investment, just keep rolling this money as much as you can until it's the time of sale, and then you pull it all out of the United States at once when you sell. The second solution is for exiting the United States entirely in the year of sale. And I think you're going to be doing this no matter what in the year of sale, just for belt and suspenders, even if you have a dividend equivalent of zero. You got the little teeny tiny thumbnail of Form 8848, which is the paperwork you file, to make all of this stuff happen. And you have the reference to the regulations. And the key thing is just don't use this foreign corporation again to do new stuff in the United States for the next 3 years. Now, how to be dumb, and then later, how to be not dumb. This Form 8848, exit the United States entirely. Let's say you've got this kind of structure and you sell one of the two properties. What's happening? Well, you've got another property and this foreign corporation is still engaged in U.S. trade or business by virtue of owning U.S. real estate. And so it's impossible to check the box and tell the IRS, yep, we're not doing business in the United States anymore. So as a general principle, you will never, ever use a single foreign corporation to own multiple pieces of U.S. real property. So here's one way to not be dumb. Spend the extra $3,000 a year or whatever it is to have a second foreign corporation, put each piece of real estate in its own little corporation. So now you can sell each one whenever you feel like it. Sell one in 2020, exit the United States with that foreign corporation, sell the other one in 2021, exit the United States with that second one in 2021. You're home free. This third solution is, we talked about the two before, reinvest or the 8848 solution. Now let's talk about the third solution, which is drop a subsidiary in between the U.S. real estate asset and the foreign corporation. And this works, as I said before, is because branch profits tax only applies to foreign corporations. And in the little diagram that I'm showing you here, who gets all the capital gain when the real estate is sold? Answer, its owner, the domestic corporations. So the profit shows up on a Form 1120, and there's no branch profit section to calculate stuff on a Form 1120. But third order effects, if you use the parent substructure, we create some problems. How are we going to get the money out of there? Because remember, we've got this double layer of taxation problem that bedevils us with C corporations. So you've got a capital gain, and the domestic corporation paid its 21% tax, which is the same thing that the foreign corporation would have paid anyway. And now the domestic corporation is just a bucket of cash, and we don't want to have a bucket of cash sitting in the United States. We want the cash to go upstream to Mr. Big, who owns the whole structure. How are we going to do this? And we know reflexively that we're going to have, distribution to a shareholder, in this case, the foreign corporation. So, is it a dividend? If not, it's a return of basis. And if not, it's capital gain. So how are we going to make sure we get all this cash upstream to the foreign corporation, the shareholder, then out of the foreign corporation to the individual without any U.S. tax? And here's how. Start with the beginning on the left-hand side. This is the structure before the sale. The classic parent substructure owns U.S. real estate. Step 2 in this 5-step diagram is sale. So the domestic corporation sells the real estate in normal course of business and has all the cash at closing in the bank account at the domestic corporation. Step 3, the domestic corporation will file its income tax returns, pay its tax, and now it's the giant bucket of cash, and it's after-tax cash sitting there. Step 4 is the key. Step 4, you're going to dissolve the foreign corporation and make a liquidating distribution to the shareholder being the foreign corporation. Why does this work? It's because a liquidating distribution of a domestic corporation by a foreign shareholder is treated like the foreign shareholder sold all of the stock back to the domestic corporation in return for the domestic corporation's assets. So the dissolution is like the foreign corporation sold all the domestic corporation shares back to domestic corporation and received all the after-tax cash inside the domestic corporation in return for that make-pretend sale. Now, why does that work? Well, capital gain derived by a foreign taxpayer is not taxed in the United States. And so a capital gain transaction like that is tax-free. It's the same thing as if this foreign person bought 100 shares of Google on the New York Stock Exchange or NASDAQ or wherever it's traded, I don't even know, and then later sold it for $100,000 profit. Is that $100,000 capital gain taxed? Answer, no. And the reason is because it's not FDAP, fixed determinable annual or periodic income, and it's not income effectively connected with a trade or business in the United States. Therefore, no tax. So now what we have is we have all the cash out of the United States in the foreign corporation. And what do we do next? The foreign corporation has cash outside the United States, makes a dividend to the shareholder, the individual, and we're home free. And we do this again and again and again for people. It works just fine. Plenty of paperwork, but it works just fine. And here are the words that describe, why this happened. So this general concept of, and this is important to reiterate, why is it in the case of selling Google shares, there's no tax on the capital gain, whereas if you have a domestic corporation that has real estate in it, there is capital gain tax problems to contend with? And the answer is Section 897, which says that if a domestic corporation has a balance sheet of more than 50% of U.S. real property, then it's a thing called a U.S. real property holding company, and the normal rules that would apply to Google don't apply to the sale of the stock of this U.S. real property holding company. And what we've done by selling the real estate, taking the cash, and then paying the tax on the sale of the real estate is we've converted that domestic corporation from being a U.S. real property holding company into being just a giant bucket of money C Corp. And so it's a nothing, and therefore we can do the liquidating distribution rule game with no tax. So again, the how to be dumb and how not be dumb. We've got a structure where we were cheap and we wanted to use one domestic corporation subsidiary to hold a bunch of pieces of property. Sell one of the pieces of property and you've got your after-tax cash. Can you make a liquidating distribution of that domestic corporation? No, because you've still got an operating asset in there, the other piece of real estate. So you're forced to either sell everything in the year of sale so you can do a liquidating distribution, or you're going to be triggering some tax by doing this. And here's the how to be not dumb. Spend the extra money for one corporation per piece of real estate. Just do it. I mean, it staggers me how quite often people are just afraid to spend a couple thousand a year for a corporate return and give up this long-term benefit. But I do not judge. So here's the conclusion on the capital gains tax. Again, at the moment, under current conditions, I really don't care about the federal income tax rates. They're as close to par as you can get. The state income tax rates matter, and you can see here that it's around 60 grand of capital gain, at which point human rates, at the 9.3 rate, exceed the corporate tax rate for capital gain in California. So which basically, is going to be most pieces of real estate that are being sold. You're going to be slightly better to have the corporate sale rather than an individual sale. And then the question is, how much overhead and transaction cost do you want to incur to gather in that state income tax savings? So, but no matter what, on the capital gains side, just remember that if you're going to use a corporate structure, remember to pre-solve, know in your head what you're going to do for the branch profits tax and be ready to implement it when the time comes. All right, that's estate tax and capital gain tax. Let's move on to rental income, which is typically the smallest. And if you have a rental property, the normal experience is you're going to have losses in the early years and you're going to have profits in the later years, just the way it works. And so really what you're going to be sensitive to is, you're going to accumulate some losses in the early years, and you're going to want to be able to offset that against profits in later years from rental. At some point, everything turns resolutely positive cash flow, positive tax, and happy days, and you have some tax problems to contend with. So let's talk about those tax problems and what you might want to do with them. The baseline is you're aiming for a situation where a foreign taxpayer is going to be taxed on net rental income exactly the way that a domestic owner of rental real estate would be taxed. There's a special election, and I'm going to tell you to do it. And we're going to have to wrestle with this branch profits tax problem again. So, tax rates on rental income. By default, the default tax rate is 30% of gross. So no deduction for property tax, no deduction for depreciation, no deduction for nothing. And this is true whether the structure has a corporate taxpayer who's reporting the income or an individual taxpayer reporting the income, for example, by way of a trust. That's what it is by default. If you can prove, however, that you are, quotes, engaged in business of being, the rental business in the United States, then you're taxed on net income using the same graduated income tax rates that domestic taxpayers use. You will always come out better being taxed on net income at the graduated tax rates than you will at 30% of gross. So you want to be engaged in business. And there are two ways you can do it. One is you can point to all the work that you do and you say, look, I look like I'm in business. I'm doing stuff. The other way you can do it is you can force the conclusion by making an election. It's called the net election. And I've given you a reference to the regulations there. Go look there for how to do it. Bolt the statement onto the back of your tax return and absolutely do this. Now you don't have to get into a metaphysical discussion with a revenue agent. Was I a passive investor, not engaged in business, or was I an active investor, fully engaged in business? You've sidestepped that risk entirely. So now that we are at the point where we know that income tax is going to be at normal graduated rates with regular depreciation rules and all the fun stuff that you and I know and love, let's talk about the branch profits tax problem and how we're going to deal with it. Now, remember that the branch profits tax only applies when you have a foreign corporation that owns the U.S. real estate. So we have situation, human owns 100% of the stock of foreign corporation, and foreign corporation's name is on the grant deed for the U.S. real estate. That's the situation where branch profits tax can apply. I guess you could slide a disregarded entity in between and would have the same result, but that's what we're looking at. There are three solutions for the branch profits tax problem when you have rental income. The first is use a U.S. subsidiary. Remember the rule that branch profits tax applies only to foreign corporations. U.S. subsidiary is domestic, therefore that tax doesn't apply to the domestic subsidiary. The second one is always run at a loss. So this is like good news, bad news. The good news is I don't have to pay branch profits tax. The bad news is I'm losing money. The third one is, as we saw before, you do a reinvestment strategy. You put your net the extra money into U.S. property so that you bring the dividend equivalent amount down to zero. Let's see how that works in the context of rental income. So here is the same part of Form 1120F that we looked at before, Section 3 about the branch profits tax. And I've got it numbered 1, 2, 3 for the 3 different strategies. So number 1 at the top, right beside the words Form 1120F. The first strategy is own the real estate through a domestic C corporation, subsidiary of the foreign corporation, and now you're not preparing Form 1120F anymore. You're preparing Form 1120, and you've eliminated the branch profits tax problem. The second one, line 1, which has the blue 2 beside it, taxable income, this is where you're studiously attempting every year to lose money. And I joke about that, but one of the ways you can do this is, if your foreign corporation is paying hypothetically some director's fees to your foreign non-resident alien director or officer of the corporation, you can take a tax deduction on Form 1120F, so taxable income can be driven down to zero by careful use of a related party transactions, let's just say. And then number 3 is the reinvest thing. Again, remember line 4C, when you put money back into U.S. assets, reinvest in U.S. assets, this reduces the amount of money inside the corporation available for a hypothetical dividend, and therefore it reduces the tax base that you use to calculate the branch profits tax. So in theory, if line 4C equals line 1, dividend equivalent on line 5 is 0, therefore tax on line 6, also 0. Here are the words that go along with it. And now let's talk about what were second order effects. Let's talk about third order effects. Yeah, we used a foreign corporation to eliminate the estate tax. Yay. Oh, it has second order effect of branch profits tax. Oh, okay, we're going to slot a U.S. C Corp subsidiary under there to deal with the branch profits tax. Oh, third order effect. We've got personal holding company tax and we've got accumulated earnings tax to deal with. So these are 2 problems that you've seen, I'm sure, with many domestic C corporations. So it's not like there's anything new here. You just need to know how you're going to get around those 2 things. The accumulated earnings tax is, are you accumulating too much inside this corporation, quotes, beyond the reasonable needs of the business, close quotes. Fun fact, foreign corporations could be a risk for this, but I'm just flagging this to let you know that it's there and it can be a problem. I have situations where people invested extremely well a long, long time ago, and at this point they're running positive cash flow of a couple million a year into a domestic corporation. What do you do about that? This is the territory of accumulated earnings tax. The personal holding company tax is the same thing. It's designed to force a dividend to come between the rock and a hard place. Do we pay the personal holding company tax or declare a dividend? And again, you're going to have to wrestle with this. I'm not going to give you an answer. I'm just saying, here's a problem with the parent subsidiary structure. Having said all that and waved my hands at those 2 taxes and said scary monsters and all that, hiding under the bed, I'm going to tell you that unless you have a situation like the one I described, where it's an extremely long-term holding structure, and it's wildly profitable and it's depreciated to 0, the foreign parent domestic subsidiary structure is going to probably be okay. And the reason I'm going to say it's probably going to be okay is you can probably set up some officers' salaries paid to a non-resident alien officer, or director's fees, or investment manager or fees, or stuff like that, to reduce the taxable income of the domestic subsidiary enough to make the tax problems more or less go away. The second reason I like it is that, as I said, in the early years, rental income usually runs some kind of loss. And you want to accumulate those so you can use them to offset profits from rental activity, or indeed against capital gain later if when the time comes. You don't want to lose those carry forward losses. So that's why I think a parent subsidiary structure is, even though I say, yeah, there could be a problem with extremely high value assets, it's probably pretty good for normal people making normal kind of investments. Or I'm going to give you an idea that we've used a number of times, and I commend this to you for thinking about in the future as you're setting up holding structures for real estate investments. Try to get the best of all possible worlds. The eliminate this mess entirely is just bite the bullet, spend the extra time and money and incur the extra brain damage to set up the irrevocable trust structure from inception. So you're going to have an irrevocable trust. It owns a disregarded entity. The disregarded entity buys the real estate. Step 2, if the real estate is operating, rental income continues, you're going to be flowing rental income through to the beneficiaries on a K1, or you're going to be paying the tax at the trust level, but let's just say you're going to be rolling it through on a K1 to the 1040 NRs. Passive losses are going to accumulate there on their returns. So eventually they'll be able to use those losses to offset rental profits or capital gain. You don't have any personal holding company tax issues during the operational phase of this rental investment. You don't have any accumulated earnings problem. You don't have dividends with 30% tax, nothing like that. It just works. Then immediately prior to sale, let's do a little bit of tax rate arbitrage and make a C Corp election for the LLC. So now when the property is sold, it's going to pay state income tax at 8.84% California instead of whatever individual tax rate way higher that you would have if you just left the structure as is. You're going to then report the capital gain on the corporate income tax return, dissolve the corporation, and send the money upstream to the trust and then through the trust to the beneficiaries. Now, you can see I've made a heroic assumption that any passive losses that are sort of pooled in the early years, we've used up in some fashion, so we're not sort of leaving some unused passive losses on the 1040 NRs of the beneficiaries. So here in my beautiful little diagram is how it works, step at a time. You're starting with the rental phase of this investment, where you've got real estate owned by the irrevocable trust, which owns a disregarded entity, which owns the U.S. real estate. The decision time comes, we're going to sell. So you make the C Corp election, and typically I'll do this with an effective date of a couple weeks before the expected sale. Because once you make this, you're going to, this sort of triggers a whole bunch of time deadlines. And so you want to give yourself as much time as possible to do whatever you need to. So now then you complete the sale. And step 3, you've got a C corporation that got a bunch of cash. It paid its income tax. It filed Form 1120. It paid the tax. And now it's just got after-tax cash in there. And step 4, we're going to go through that same liquidation drill that I talked about before. And so now the C corporation is going to liquidate and distribute all of its assets, namely the after-tax cash, into an irrevocable trust. That tax inside the trust, it's all tax paid, so it's free of any claims by Uncle Sam and Uncle Gavin. And so it can now be distributed to the beneficiaries in any way that the trustee chooses. We're done. So this will work. You'll have to, what we do is we will have a sale and liquidate the corporation within 30 or 60 days after the sale is closed. That triggers the 15th day of the third month for the final tax return. So the C corporation has a short year, start and finish Form 1120. You also have, just so you know, a little side brain damage paperwork. You have Form 1042, 1042S stuff to deal with early the following year to report the distribution of assets to non-residents, and you do that. No tax, it's just paperwork. So there we go. This is as much as I can tell you in 55 minutes about investing in U.S. real estate. If you're a non-resident alien individual and you want to buy rental property, eliminate the estate tax first, use an irrevocable trust or a corporation, optimize for capital gain tax second. Corporation is generally better than that, and you're either going to start with a corporation from the beginning, or you're going to throw a corporation in right at the last moment, as I described just about a minute ago. And then finally, you're going to optimize for rental income because it's the smallest number. And we talked about using irrevocable trusts or corporations there to reduce the total tax on rental income and reduce the collateral damage from the personal holding company tax and accumulated earnings tax. So, bottom bullet point, I commend to you this irrevocable trust idea with the Form 8832 election to make the disregarded entity into an LLC, into a C Corp. Here's my fancy dancy disclaimer. I'm not your lawyer. This is just me talking off the top of my head. Don't listen to me. What do I know? Go hire somebody or do your own research. And there we go. With that, I will bid you a happy Friday the 13th. I'm going to bail out early and take the afternoon off and have some fun. There's my email address. There's my phone if you want to brainstorm. If you have a question, if you say, Phil, what the hell were you saying when you said X? I'll either say, oh, that was dumb of me. I was wrong. Or I'll tell you this is what I meant. Anyway, that is it. Godspeed. See you next month, December 11, noon Pacific time, where we will talk about the intricacies of partnership investments with multiple U.S. Non-resident aliens buying the equivalent kind of U.S. real estate. That is all, and have a happy afternoon. Bye-bye.